Well, thank you very much for interesting presentation. We obviously are financial analysts, so inevitably our attention will focus on page 23, I'm afraid. An introductory question is how much of the support from the macro you expect, and being more specific, what is your assumption on interest rates growth that you have plugged into your models? Because from the charts here, you seem to be looking at 100 basis points growth over the next 2 years. This is the first question. I may actually shoot three at once, if you don't mind. Secondly, you are very brave to give us your specific net profit targets. Normally banks give us ROE, and this is the thing you gave us last time. I understand the considerations, but nonetheless, you're also aiming to become or to remain top 3 bank by ROE. So my question is, what is your assumption on dividend payout? Because you have to plug in something into your model again. And thirdly, how much of your business growth is dependent on PSD2 and new customer acquisition? I know it's a simple question. Answer is probably not that simple, but still, we would like to know how much of the growth is organic and how much of the growth is acquisitive.
Maybe starting from the last one, trying to not put too much numbers, but the most relevant driver for the revenue growth is customer acquisition. In terms, I think that when you asked about the PSD2, you asked maybe more in terms of consumer loans, maybe. So this would be the second driver, and probably the third would be corporate. I would translate like that, although this cannot be by no means one third, not at all, because the first one is more relevant. Then
so regarding the assumptions, of course, first of all, this is an ambition of reaching this level of net profit excluding extraordinary events. This is the first thing that we should state. Second, we are trying to reach this ambitious target of net profit without relying too much on increases of interest rates. Of course, our macro scenario points to an increase of interest rates, but it is not certain. So it depends on different evolutions that will happen in the nearest quarters, and so the achievement of that target, of course, would be very much supported by the increase of interest rates, but does not rely solely on that increase. I would say relies to a minimum extent on that. So we are still working in a conservative way that interest rates will grow slower than the macro expectation that we are putting on the table. And regarding the dividend policy, as you know, we cannot be. We have to repeat what we already mentioned today in the morning in the press conference, which is we keep our dividend policy of distributing 35 to 50% of net profit, but subject to regulatory restrictions. And today there are still 3 which are not clear for us, so we need to wait for more clarity. But of course, in the medium term, we want to be able to come back to normal dividend distribution.
Banging the drum. How much? I mean, well, inevitably we'll keep on asking these questions. How much of your business improvement is coming from your loan and asset mix change? I specifically mean, when you look at your recent numbers, you see that the reduction of the Swiss franc portfolio accelerated. This is probably because of payoffs, voluntarily payoffs. And do you extrapolate this trend, or because your assets will benefit, or your mix will benefit your profitability over
So as we are showing in the presentation, it is more or less easy to break it down. We have on one side, we have a total decrease of the portfolio of 12% year on year, while the FX rate changed by 5.5% year on year. So in fact, we are having a amortization in currency of around 7% a year, which is a little bit higher than what it used to be. And we are anticipating that if there will be no major changes in the market, that we should have at least this level in the nearest years, if not higher, excluding any let's say legal or regulatory driver for further acceleration. So we believe that, and this of course will help to further dilute at a quicker pace the FX mortgage loan portfolio.
Maybe a follow-up question. Could you please share with us what would your net interest margin be without the FX portfolio?
We don't have it calculated as such, but I can tell you that our FX mortgage portfolio has an average margin over LIBOR of around 135 to 140 basis points.
And it constitutes 32%, yes, of
total
loans.
Maybe also a follow-up question regarding the dividend. It seems that you did not include any part of first half profits into the capital. Does it mean that if it would be possible, you would be eager to pay 100% of your profits out?
No. Again, dividend policy 35 to 50. First thing. Second, 3 still aspects to be cleared up during the fourth quarter, which I can explain. The first one is the updated capital buffers connected with the FX mortgage loans, which are supposed to be known during the fourth quarter. Second, the letter on dividend policy from KNF, which is also supposed to be known in the fourth quarter. And third, clarification regarding the systemic risk buffer that will enter into force on the 1st of January 2018, 3%, and clarification in the sense if it will replace the previous KNF buffers of 4 and 3% for total capital ratio and Tier 1 ratio. So these 3 elements are very important in order to have more clarity about the minimum required ratios that banks will have, and so only having clarity we can further let's say elaborate on the probability of distributing the dividends. But in no case we are speaking about 100% dividend distribution, even because as we are showing, we have the ambitious targets of growth of the loan portfolio in the next 3 years, for which some organic generation of capital will be needed. Apart from that, we are considering the possibility of issuing some subordinated debt, and there are 2 drivers for that. One, of course, is market environment, which is more favorable for the issuance of subordinated debt, as shown recently by issues from other banks. Second, it would help to create some additional buffers, but third would, first of all, have the possibility of having a more efficient capital structure, because what we have today is completely not efficient. We have a Tier 1 ratio at the same level as the total capital ratio. And so by having some subordinated debt, we would be in more conditions to fulfill the regulatory requirements and at the same time being able to distribute dividends.
Maybe a question regarding the capital issues, because you did not mention the increase in the minimum LGD parameter. Do you still consider this as a possibility, or do you think that this will be regulated somehow within the additional FX buffer?
We do not have any visibility on that. We don't know if it's going to happen, and if yes, when. So I would add that this is a fourth unknown issue, which we are not certain if it's going to materialize or not. So it's a rather technical issue, but we do not have visibility on that.
Good afternoon. Maybe I have a couple of questions. Maybe I'll ask them like two in a row and then continue. So IFRS 9 coming in January. I'm of course interested as well in the capital adjustment, but I'd be more interested in the change in the risk model and the potential change into the risk charges that will be implied by IFRS 9 2018 and going forward. So how do you think you must have practically a new system almost ready to start working January 1st? So how we can actually expect the cost of risk to evaluate next year, given the new group of loans that will be subject to provisioning. Also, NPL ratio, it didn't go up that much, but it ticked up after the third quarter. Nothing really worrying, but like, could you explain what are the trends you're seeing going forward, especially in 2019? And the last one on the asset quality before I stop and then I will ask some other groups of questions. You basically, yeah, you said you expect cost of risk in line with historical guidance, historical trends. I don't know what kind of history we can refer to because your average since 2008, between 2008 and 2016, is 65 basis points. Seems very reasonable, but is it something that we can refer to in the long term? Thank you.
I was not going so far back in the past. I was pointing to the ones that we have even highlighted in the January presentation of results when we showed the last 5 years, and we were showing that we were in a range between 48 and 65, if I'm not mistaken, but most of the time between 50 and 60. So I was pointing more to that, but I'm not pointing. I don't want you to take from this that we are committing to an average number. It's more that per portfolio. Is that because we have a certain cost of risk for mortgage, we have a certain cost of risk for consumer loans and for companies, and of course through time our structure of the loan portfolio will change, and consequently also the average cost of risk will change. So what you should look at is at each main portfolio, and then the evolution that we will have will tend to follow some historical risk guidelines. But this is more to show, the message of this is that we are not going to enter into an aggressive mode that would significantly increase the cost of risk, except that in consumer lending we are also showing in the strategy one area, which is selling consumer loans to non-customers of the bank, which is of course new territory, right? For which we will need to conclude what is the proper cost of risk for that segment. Coming to the first question about the IFRS 9. So we still did not disclose estimation of impact because we are still finalizing all the works connected with the implementation of the standard. We will be ready, of course, and probably in the presentation of results of the fourth quarter we will already present the estimation of the impacts. There are two major things to consider. One is the initial adjustment and if it has or not impact on capital, and the second is the ongoing impact on the cost of risk. Regarding the first, although I cannot yet speak about very concrete numbers, with the work that has been done so far, and due to the fact that we are an IRB bank, it seems that we are not going to have a negative impact on capital in the transition mode. Due to the fact that although there is an initial increase on the stock of the provisions, for an IRB bank there is at the same time a decrease of the difference between expected and incurred loss, which is currently deducting to own funds. And as a consequence, plus one or two additional effects brings us to the current expectation that there will be no negative impact on the capital ratios on the 1st of January. Total capital ratio.
So you basically expect to have a one-time adjustment, not to spread it over
No,
5
no.
years.
This is just the first impact. Then on an ongoing basis, it is possible that the cost of risk will be slightly higher than what we have been having in the past due to the criteria for the recognition of the let's say of the change of the quality of the loans matrix, but this is still, I still cannot provide you guidance on what is exactly, what can we predict in terms of ongoing additional cost of risk due to this impact. Maybe in 3 months' time we will already be able to be a little bit more precise about this.
So again, just a small follow-up, but your strategy is binding for IFRS 9, so I assume that your sort of cost of risk outlook in line with historical trends is also incorporating a little bit IFRS 9, yes? Just to make us a bit more peaceful.
Yes. Yes.
Okay.
The second question was about NPL ratios. So again, in the third quarter there was slightly higher provisions, but when we look portfolio by portfolio, in fact the difference was minor. We had a little bit more for total corporate, including leasing and factoring slightly, and also we have more for consumer loans. But still, when we look at non-mortgage retail loans in the third quarter, the total cost of risk was around 211 basis points. So it means that we have been, last year we were below 200. Originally we were expecting to be between 200 and 300. So now just in the third quarter we are at 211. Year to date still below 200 basis points. So this is, there may be fluctuations from quarter to quarter, but does not destroy the trend. So that's why this 54 basis points year to date cost of risk is in line with what we could expect. And let me also add that we did not have any sales of NPLs on one side in the third quarter. Also, there were no relevant write-offs. This is just also explains partially this small increase in this impaired loan ratio from 4.5 to 4.6% in the quarter. But for now, apart from some level of conservativeness that we assumed regarding a few exposures that translated into provisions, we do not see any relevant change of trend here.
Okay, so maybe like a few more questions. You are mentioning a lot about the IT investments and digitalizations in your strategy, and you mentioned that every 2 weeks you have a rollout of a new IT project, etc. But when I look at your intangibles levels on your balance sheet, they are very low. They are much, much lower than the intangibles at any other Polish bank. While you commit to the investments, and we see the front end of that sometimes as customers of Millennium, you seem not to reflect it in the investment level. Do you have such a fast depreciation, or do you book it in the operating costs? Because basically you can't see any increase in intangibles. And the question related to that, but only on the IT level, the PSD2 January 2018, will you have a sort of interface for the external players to access the data of your clients? Will you be ready for January? And last question, completely different area. You mentioned in your strategy that you will accept opportunistic M&A activity approach, like I understand that the target needs to be interesting, complementary, but like, how do you define how big could be your investments ambitious in case something really ideal and perfect comes on a way and allows you to grow not only organically? Thank you.
So the first question you already answered. So if we do a lot internally, we end up to have OPEX instead of CAPEX. And this was not a decision because of that. This was a decision that from some time ago we thought that this digital capability is a competitive advantage, and this is core for our activity. So being a core for our activity needs to be insourced and not outsourced. And so we have more developments than outsourced. And so we end up to develop more than buying just software or investing in projects like that. Yes, we plan to be ready for API. We think it's important to have a high API. Now we need to have also people from the other side to be able to connect with the API. So we don't believe that should be a common Polish infrastructure that will allow everybody to connect with all the banks. We think that the protocol should be one standard. We have been working also in that area to the Polish banks to have an API, even because we think that there is an attack from German institutions to the Polish banking system, and this is not fair, and because they are using European Community for all of this, and this is not correct. So yes, we think. Especially also it's important to provide the proper security to the customer data, because not always the institutions are using what they are authorized to do. So if you are under a consumer loan company and you request to go to a bank to collect the data for a consumer loan calculation, it's very important that this institution is just allowed to get in and to make the calculation of your credit capacity and not to extract all of your financial life. Besides that, in terms of security, this is very relevant. As you know, we already had several cases of cyber attacks here in Poland. Thank God our bank was not attacked, but we were helping some other colleagues, and even some of the banks that were attacked, they were coming through authorities' connections. So I think it's important to also to have in this part. In terms of M&A, when we say opportunistic, means that we don't have a clear plan and definition about what we are going to do. So it's otherwise we would say that we have a strategy of planning acquire a certain size. We know a couple of things that for sure. First, it needs to be a transaction done and approved by the market. So it's very relevant that that brings value, that it's not only a strategic shareholder that it's committed to make any investment that is required, so it needs to be accepted by all the other investors, so good for a big investor but also for a small investor, and it needs to have to leverage or to increase the earning per share and not to decrease it. More than capital, we think that to make an acquisition you need to have the people and the process to do it. We think that now we have the people and the process to do it. There is no ban for acquisitions at the moment, so if there is the right opportunity and if there is a value creation opportunity, we will present to the market, and then we will see.
I would have a question about new mortgage production. In the presentation you said that 60% of the new production goes to new clients, so it means effectively that almost entire growth in new production comes from clients outside the bank. And the question is, how do you feel with the quality of this new production? I know that this is more like long-term engagement, but still I wonder what is your risk appetite in this segment nowadays. Thank you.
As you know, the most critical moment for shopping around in a bank is when you do, as a customer, the mortgage. You don't shop around for anything else that you do in the banking. Usually you open an account with a branch that is nearby or a stand in your university, then you buy the credit card that the bank is offering, and so on and so on and so on. The moment that you really go door by door and you don't, at least I don't know nobody that took a decision without consulting at least 3 banks, is when you make your mortgage. So it's because of that there is a natural trend of having external customers. 60 is even very low. 60 is even very low, because unfortunately we don't have 40% of market share. So it's 60 still. So it means that 40% is from our side, and as you know, we are more a 6% retail bank than a 40. So it's quite good. The assessment of a credit capacity for a mortgage is completely different. So I would say that the increase of quality that we see for the consumer loans, we do not see, because it's our customer base, we do not see in our mortgage customers. So we don't have a experience that we would say that our customers behave better in the long run than third-party customers. We have a trend of fully on board our customers, so it means that after a mortgage, they fully work with us, even because there is advantages in terms of pricing to have salary and to have usage of current account. And as you know, we even are a little bit more demanding than normal in terms of insurance. So we demand not only the asset insurance, but also the real estate insurance, but also the life insurance on top of that. So for the time being, I would say that for us this is a normal process, and there is no deterioration in terms of credit quality of the loans.
Can I just ask a technical question concerning this 1 billion zloty of net profit? Your remark is that it excludes one-off events. Is this including the existing asset-based tax, or this is not including that?
It's with the banking tax. Yes.
Banking tax
is not considered
not extraordinary anymore.
Yes. Let me just, because we have here 2 questions that are still connected with capital requirements, and especially with where do we expect to be by year end, and also, and the second question is regarding how we assess the draft act that is under discussion regarding FX mortgage loans. So maybe I would answer the first one, just to be clear. So as we said, the picture we believe that due to the updated information that will come during the 4th quarter, we will have at least clarity about first the size of the buffer connected with FX mortgage loans for our bank. There will be an update for everybody, but each one will have a different update. In our case, due to the fact that on one side we had already release of the IRB floor in July, we are expecting that there will be also an increase in the required buffer for the FX mortgage. So this is our expectation, but we need to wait for the final information on this part. Second, we expect clarity about the principles for dividend distribution. And third, we also expect clarity about the introduction of the systemic risk buffer versus the old KNF buffers. Only after having these 3 components, it will be more clear to see what is the surplus that we will have in terms of total capital ratio vis-a-vis the new required capital ratio thresholds. So because of course currently we have a bigger buffer than what we showed in the end of June, a bigger surplus, but of course we still need to have clarity about these 3 things in order to be able to see where we are in terms of surplus versus the minimum required, and then to see if there are conditions or not for distribution of dividends.
In terms of assessing the new proposal of FX law, we think that we are just missing three things that are very relevant since the beginning. So we think that we need to have a social criteria, whatever it is, social criteria. We know the social criteria that we think and we like, which is a DTI, but we believe that without the social criteria, any law doesn't make any sense. We believe that we need to have a time of duration, because otherwise you analysts will put as a perpetuity. So it's like an additional banking tax. So whatever it is, it needs to have a duration. And last but not least, it cannot be cross-subsidized. So it needs to have a situation that each bank contribution is to make the conversion of the clients of his own bank. These 3 points for us are deal breakers, and we already expressed to the authorities this. And now we need to wait and see.
Thank you. More questions from here? Yes, please.
If I may, I think my reading is you are quite pessimistic about the outlook for the sector, because if I take this 1 billion of net income and divide it by your equity today, assuming that you pay out from now on everything, then your ROE would be 13.1%. If you pay nothing, your ROE would be 10%. So maybe the base scenario could be maybe 11% ROE, 11.5%, if you pay 50% or 35% of net income. Is this correct? Because it would be, I think it would be difficult for you with this ROE to be about top 3 players. You had there's one bank who already reports higher ROE. There are some banks, at least one bank. There are banks like Santander Consumer Bank, like very specialized, and it would be difficult for you to beat them. So I wonder, what do you think? What's the outlook for in general for the sector?
So it's always between to do and to, and it's difficult. We think that it's very ambitious target, and we are very committed to this target. I don't know what is your forecast for our end results. What is your forecast for our end results this year?
I don't remember precisely.
Okay, but let's say that is 600 and something. It's 15% year-on-year growth to go to 1 billion in 3 years. For us, is a lot. So I would say that it's a strong ambition, and it's with a quite good positive target. Now, why are we giving this with return on equity? Because 3 years ago we gave just return on equity and we failed, not because the return was bad, but the equity was just keep growing and growing. So now that we want to give a target that we are combining 3 targets together. We are saying we are going to make 1 billion, or even 4, but we are going to make 1 billion. They are coming for normal business, because we are saying that the core business income is growing 30%. So it's coming from normal business, so it's not a sale of an asset or something. We will keep the efficient as it is, and we will rank in top 3 in terms of return on equity, which means that it's true that we cannot control what will be the demands in terms of equity, but because the rules are the same for everybody, we will perform well versus the others. Let's see.
So the conclusion is maybe that you expect that the regulator will force you to keep a capital surplus across the sector, a massive one.
I refuse to accept that during 3 years the banking sector, or at least majority of the banking sector, will not be allowed to pay dividends. It doesn't make any sense. But also I already learned that it's better to wait for the letters at the end of the year, to not put the shareholders meeting very early. So it's better. But from another side, it's not possible to have another 3 years with full capitalization, let's call it, the results. It's not possible, I think. Otherwise, one of these days, is 40% capital ratios or something. So we already have 40% tax rate. So it's.
Let me just, for clarity, say when we are saying at the top 3 level, we are not looking at standalone banks or niche players. We are looking about top 10 banking groups, right? So not subsidiaries of the groups that have a specific business model that allows. So this is not. We are comparing consolidated numbers with groups that have similar types of structures. We are not comparing this with niche players or small players, right?
My second question would be about this investment product that you have for clients, because I think that ahead of MiFID II, banks are reorganizing the operations in this area, and I think you till now you are still an open platform. You sell a lot of external funds, I think, comparing you to other players. And with the cyber and robo investments, do you plan to change this? Or what is the actual change? You introduce just a platform for mass, or are you changing something?
So at the moment, so this is going through phases. So first of all, let me tell you that the infrastructure that we already prepared and launched is already MiFID compliant in the first part. So it is without the full advisory. It's just more in the execution part. Have some support, but it's more in the execution part. We will have a second phase before the summer next year, already with the advisory part. And the reason why we are not launching is even because there is still a lot of fine-tuning in terms of the local legislation for the MiFID. Unfortunately, as you know, it's not everything is not yet outside, and everything is not regulated yet. And so we will have this part before the summer, but the full robot advisor, as we know it, so with algorithms and everything, we just plan at the end of next year, because then we need to digest also what is going to be possible and available to that. We are at the moment already in selections of the tools, but this is technology. This is not regulation. The most important part here is also the customer experience and interaction. I advise to test the system. By the way, the first exam to be accepted, because it's a requirement of the MiFID, it's not easy. So at least I had to stop for a while to think.
So, more questions here from the room? I don't see. We have maybe the final from internet participant.
Now we have here a question in terms of how to square our opportunities in M&A with our major shareholders' capital restrictions. So it needs to be done with them. So it's after the end of this year, the ban of the acquisition is out. So we think that if it is a strategy that is value added, it will be accepted by the market, but also by the major shareholder. And also, it's not always an acquisition requires capital increase, and I think it's also important to understand that. How confident we are with the 2020 guidance, which is 15% above the consensus. It's true. It's we are confident because we are leveraging in a very good time. We had a challenge to offset the banking tax in 3 years. That was our plan, because it was a cut of the net profits of 30%. In that time, we thought, okay, 30%, 10% per year will take 3 years. We looks like we are going to take 2. So it's when you have a good moment with good profitability, solid and good customer acquisition and revenue growth, then you are a little bit more ambitious. But we are quite confident.
Thank you. I think it's better to be above consensus than other way around. And you would ask, what is the strategy? So thank you. If there are no more questions here, also, so thank you for keeping you a little bit longer. But this was strategy, so I hope that you got all the needed information. If not, please also send to me. And thank you for participating. And see you on the next conference already in the new year. Thank you.